Welcome, everyone. My name is Rob Ellis with Horizontal Land Partners, HLP, Gulf Coast Equity Fund, Midwest Residential Fund. These are all trade names that we operate under. Today I'm going to be walking you through our website we just built. But in case you guys want to learn more, you can see all of those disclaimers are right here. HLP Fund, Gulf Coast Equity Fund, HLP Gulf Coast Equity Fund. They're just trade names used by Midwest Residential Growth Fund 1, which is our Reg D Delaware Fund. Now, let's get started. So, I write copy now. I run a media company. I've been in real estate 11 years, and so we got started. When I started to get into media down here in Miami, there was a really big appetite for real estate, more than traditionally what people invest in down here. People are sold 10% pre-funded condos, and it takes them 5 to 7 years to get them. The appreciations down here are amazing. They're greater than, I would say in Miami, it's more than 10%. We underwrite 12%. And so I want to show you guys another way that you can replicate that in a market that we looked at yesterday. But first I'm going to walk you through our site and kind of just help explain what we're looking at. So what we say, America's working class, the world's most stable asset class, which to me, it means that there's I'm down here in Brickell, and every day that I meet people, there's someone that moved here from Alabama that learns how to create, bought a course, does very well, changes their life. It's amazing, but it's one person out of a lot of people that will never do that. And so, in my opinion, at least where I'm from, my entire family stayed in Ohio. All of my friends stayed in Ohio, all of them. There's not a lot of movement when it comes to places like Rust Belt or places like the Gulf Coast. So when we say that America's working class is stable, it's because they are. They're not a number. They're something that you can invest in, right? You can invest in the homes that they live in. Institutional, capital-light housing and essential land across the Southeast and Gulf Coast, the last major corridor where it's still cheaper to own than rent. There's a lot of Zillow trolling articles that you'll see where it says there's only 2 cities left where it's cheaper to rent than it is to buy, and that is far from the truth. I think there's a lot of cities, there's plenty, and I don't know the number, but that's part of what we're touching on there. The other one is institutional, which means Wall Street. It means pooled capital. It means organized patient capital, right? It means we take an institutional approach and benchmark against a publicly traded peer group. Capital light means 2 things. Capital light means we use contracts and options to control markets like Ryan Homes does. Ryan's Homes average home turn, which means from when they purchase it to when it's sold, is under 100 days where I'm from in Ohio. We looked at the price bands that did that, the floor plans that did that, and when it came down to it, it actually wasn't the market, it was the technique. And so if you read Ryan Homes' disclosures and their financial statements and their 10Ks, you'll see that they're one of the most efficient home buyers and builders in America. They buy land and they sell houses. They assemble stick-built homes on site, and that's what made them been extremely efficient. As a developer and general contractor, well within our capabilities. Again, I'm not the one that's making decisions. The decision makers here are the committee, right? So as capital flows and committee members want to become a part of a committee, you take 6 houses to a committee and say, what do we think? We use very small. When I used to buy and sell homes, especially for investors and even myself, I think we got the cost of buying a home down to less than $1,500. Okay. We have working class. 42% of the U.S. population is in the Gulf Coast corridor that we're targeting. 35% of homes, 35 to 55% of the median home values are below the national average. 4 to 6% rent growth over 5 years. 30 to 40% operational velocity, which is faster asset turns than other firms. We're not waiting. And because of the types of homes we buy, again, we're not waiting. And then there's a REIT, institutional benchmark, built on REIT buy box data. Geographic, this is markets at a glance. This is my favorite place. And we're still building this out, but this scores the various markets by cities and states. And it doesn't always mean it's the best deal. It does mean that where do we want to anchor them? It means that if we don't buy in a property with 92 or a state with 92, do we have a reason to? It means that, can we explain it to our own selves? Can we use logic and reason? So what we say on this is the Gulf Coast corridor spans 10 states and 19 metros, representing over 40% of America's working class population. Our composite scoring model blends affordability, rent-to-price ratios, migration velocity, and occupancy rates to pinpoint metros with the strongest risk-adjusted yields. Now, this is surrounded around data analytics, public records polls, active inventory, transactional activity, REIT, home purchases over 100 houses, or multifamily purchases. There's a lot of independent things that go into these formulas, but I don't think anyone cares. I think they just want to see the data. So you can see the top 6 or 8 here. And then you can see, if we click here, this is where I have the first 10 done. You can go by metro, state, or by thesis. Okay. So Texas, tier 1, migrations, the median price, and occupancy that you can purchase there. We found a submarket called Beaumont, Texas, that is a great deal. I'll run through it on our. I'll pull the pictures up here and put them on the screen. But that is one of the ones that we want to look at. So Tennessee, you see, migrations, median price, occupancy, rents, foreclosure rates, and then the score, right? I'm still building out a lot of the scores. You can see a lot of our targets isn't above this. I saw a single family home that did an announcement yesterday, a press release. They were looking to release approximately or buy homes up to $500,000, which rents don't go that high, unfortunately. So our focus is on the old 1% rule that I learned on Bigger Pockets from posting 4,000 times. And from all the wholesalers and from all the out-of-state investors that came to me and wanted to buy, things never changed. No one said, I want to buy a $500,000 house and rent it for $1,500. So some of these markets don't work, but there's gaps in the market where there's inefficiencies, and there's the ability to adjust. So you can sort these, look through them. You can see the data sources and click through and see where these are coming in, right? You can do it by state, and here's that thesis. Affordability-driven demand. Gulf Coast states maintain price-to-income ratios 20 to 40% below coastal metros. Texas, Alabama, and California. Now, there's parts in Texas. Like I told you, we like Houston a lot. Hines just sold a massive land portfolio to Starwood. And when I called Starwood's office is in Tampa. And I said, hey, why don't you guys buy some of this land that we're going to look to entitle? And they said, no thanks. We're going over to Houston. And so they're going really deep into organized, what we would call master plan communities, which is something that we've published a lot of work on maybe in the last 6 months. Master plan communities are an amazing way to grow, but they're really slow. So if we do a master plan community, that will be a separate roll-up more than likely that we would raise for. But for now, that's one of the advantages for us. But they're in the Houston market, so I can't buy where Starwood Capital did or Starwood Land did, but I can. And they're one of the largest land aggregators, and they're out of Miami, and they're extremely efficient. But they made Hines about $200 to $300 million at a minimum, and that to exit that portfolio, it was a land deal. They bought all the entitled land, which means they took no risk, and they have all the upside, and they gave someone a little bit of profits. We did the same thing. I sold land entitlements. I did land entitlements for 4 years for other firms as independent advisories. Manufacturing and logistics renaissance. What we say is Texas, Tennessee, and Georgia leading manufacturing job growth, 5 to 9%. Reshoring energy infrastructure and port expansion create wage growth without coastal cost structure. Ideal for entry-level home ownership cohorts. What does that mean? It means that stuff ships into Jacksonville and has to come across I-10 to be shipped into Texas. If it's not coming in through Houston, depending on shipping routes, it means it's the same thing that Wall Street has invested in. It means that cold storage has to be located on these corridors, gas, truck shops, logistics, shopping centers. And if you look at, for example, Tallahassee has one of the top 2 land-grant colleges in the state of Florida. There's a county called Gadsden County, and they have one of the highest mobile home park rates of all of Florida, and they're on I-10. And you can buy 700 acres over there for a few $1 million. That's an example of a project that we would take on for a mobile home park if we could get the entitlements that we want. And we would also bring in some manufacturing. You can build truck centers. If you look at Buc-ee's, they are employing, it's almost like the new Walmart, right? Where Walmart never owned gas stations, and Kroger tried to do it for a long time, so did Meijer, but those are in small towns, not in corridors with high trucking pass-throughs. So if you look at Love's and Buc-ee's, they are expanding everywhere. They've never stopped. We'd love to own fueling centers, right? But that's not SFRs. So, but that's just a little bit about the corridor. It means that Buc-ee's is expanding across I-10. We look at each one that they build is $50 million. You know, they have to create massive amounts of pumps, and that's the kind of place that we would look at. Institutional SFR penetration gap. Single-family home rentals or single-family residents. Well, the Sunbelt metros like Phoenix and Atlanta have 15 to 20% institutional SFR ownerships. Secondary markets like Birmingham, Mobile, Chattanooga remain sub 5%. This creates acquisition arbitrage and portfolio scaling runway. I'm going to show you guys an article. Someone in Trump's camp, let's see here, Jackson, Mississippi. Trump, 1,200 units. This is a recent, yep, here we go. There's no public record. There was a guy, Jared, I think his name is. Let's see if I can find the article. In Jackson, Mississippi, let's see, purchase 1,200 units. Let's see here. There's a New York firm that Kushner, that's who I was looking for. Okay, this was back in 2021. Alrighty, this is a press release by them. But again, we just look for institutional activity. So Kushner Companies purchased 4-property multifamily portfolio in Jackson. Now, what are they buying? This is the kind of activity that I saw in Columbus, Ohio for 10 years before it became a little bit too difficult. And then the firms from Atlanta and all these other places moved a little bit outside of there. That's it, 1 hour outside. They never changed their markets. They never did anything. American Homes for Rent has been there since 2008, and they're not changing that. And now we see bigger firms entering my markets in Columbus, Ohio, which means the wave passed. A lot of the properties they're buying are pretty bad or building. It's not the price bands that we're talking about. Kushner Companies has purchased a 4-property residential portfolio in Jackson for an undisclosed price, which actually I don't think it was. Blake Mara, Tommy Bronson of Newmark represented the seller, a publicly traded REIT, MAA. Right? So if you look up this, MAA, Mid-American Apartment Communities, is what? Publicly traded real estate investment trust based in Memphis, Tennessee, that invests in apartments in the southeast and southwest. As of December, it owns 300 communities and 100,000 apartments. Great. So we can buy apartments or we can buy SFRs. Part of ours, we write in SFR clusters. The portfolio spans 1,200 units across 71 acres, includes pools, fitness centers, tennis courts, playgrounds, So if you had 71 acres, you could put 1,200 units on it. If you look at that density, let's see, it's probably under 8. 16, wow, that's actually pretty high. So for like residential, I'm surprised that they got that. But that's 16 units an acre. So the property's amenities included pools, whatever. The 4 properties are called Pear Orchard, Crosswinds, and they were built between 74 and 88. Now, I used to, in Columbus, Ohio, homes are, I don't think there's the right time. You heard 1970 for a long time, but a lot of operators don't actually understand that. As a licensed general contractor and developer in Columbus, Pink Development Construction, we build houses and we remodeled houses for a long time, hundreds, and did a lot of exterior work and demolition, and I worked for projects nationwide, and I would say 1970 is not the right year. If you look at modern building materials and methods, it went from plaster and lath to drywall in the 40s, late 40s. So we typically say at the earliest, it's like 1942 was around the turn in my market. But it's what we're actually looking for is what's your plumbing system? Is it cast iron? You know, I was doing a lot of flips, and there's always emergencies or accidents, and it's underground, right? Or it's in the basements, or it's things that you can't really predict. So in a lot of these markets, there are no basements. It says 5. And that's it. So we're going to look at this. That's one of them. That's a little bit of an older press release. But there was actually, here we go. Here's Commercial Observer. This is a commercial real estate one. But New York Community Bank lends $120 million for Kushner's Southeast expansion. New York Community Bank provided Kushner Companies with $120 million in debt to acquire 4 multifamily properties around Jackson. Now that means that if we raised the amount of 20% down to put down, we could do 1 acquisition to get it done. And one of the things that I mentioned was, this is one of my posts, why am I hunting $20,000 houses in Mississippi? If Trump and Kushner-linked firm is scooping up 1,200 units, what's stopping you from snapping up $20,000 houses? Which what I like to ask. That's just a question. Okay, look at the real deal. This is a New York. It says they're betting on the Southeast, Mississippi, Tennessee, Virginia. Now, Virginia's not those, but Virginia's in the Midwest, right? And it says Kushner Companies, a real estate acquirer, signed to snap up 2,500 apartments in Mississippi and Virginia. The overall price was $400 million. Now they're buying a stabilized asset from another firm. Someone else had to come in and buy those. The company, which built its bit off more than it could chew in Midtown, see? So they bought in a tier 1 capital market office, which is garbage, by overpaying for a 1950s office building, turned its attention to buying apartments in small to mid-sized cities, including in the Southeast, where prices are less expensive last fall. The recent deals include the acquisition of 1,200 units in Jackson, Mississippi for about $160 million. The average rents are $1,000 a month for a 2-bedroom apartment and $900 for a 1-bedroom apartment, according to Morali. Morali said Jackson was appealing because of its strong economy. The firm is looking for more deals in New York, but the market has been slow because of uncertainty in the pandemic. We were looking for opportunities in New York. The firm notably paid $1.8 million. So these are the way that operators work. This is an institutional approach, which is we buy, we stabilize, we hold. And if someone wants to buy us and trigger something large, we'll do it as long as we have something lined up. So if we had another property tied up and we 1031 into it, then there's no issues. So as we do these deals, we talk to investors and we say, what do you guys want to do? Kushner Companies is actively acquiring properties in South Florida, $20 million for a slice in Edgewater in June. That's very close to where I live. That's a land deal. So these types of firms, our goal is to follow Wall Street and New York money, and you can see they're in the markets that we're in. Kushner Companies was founded by Charles Kushner, the father of Jared Kushner, Donald Trump's son-in-law, and a senior advisor during his presidency. That's what we were talking about. So they still mention it. The firm and its affiliated companies were under heightened scrutiny during Trump's tenure in the White House. In April, an administrative law judge found an apartment management tied to Kushner. So one of the things that they're also doing wrong is buying in blue states. We purchase in landlord-friendly states so that property laws are in our favor. So that's just an example of the kinds of properties that would look at that. Institutional SFR penetration gap. I think we already read that one. Builder concentration, supply transparency. D.R. Horton, Lennar, and Clayton dominate new construction. Now, those are on the higher end. We also look at Ryan Homes. We talked about a little bit. Their quarterly reports provide forward visibility on inventory pricing and buyer demand. So do their land firms. Lennar just spun off their land firm. And so does, D.R. Horton also owns a separate land firm. And that's the benefits of growing with a real estate development firm like ours. We have the ability to roll up different entities and push them through, more of like a private equity look at things. But what you see there is their land teams, it takes years to get a subdivision sold. It takes 4 years from when you start to sell at a 250 home subdivision. So when someone takes that position, we have a long time to go. And we can also help drive interest from those builders. Companies like Arbor Homes, we've studied all of their floor plans, all the transactional activities. It's owned by Clayton Properties Groups. It's one of their 9 projects or one of their 9 firms. And what they have done is pushed everything into ranch slab on grade homes to be able to enter the market under $300,000. They have 6 different floor plans that can be purchased, and which is amazing. Just as a side note, this is construct 7,500 homes. This is what happens after Invitation Homes grew a lot. They had a 10-year plan, a 10-year Pan-African Housing Fund initiative, involved significant planning, financing, coordination. You can watch the video. Oh, no, that's not it. Where is it? This was with Lennar. Now, I don't know why, or no, it was Pulte. Pulte got the contract. They're paying Pulte us. Here we go. This was back in 2021, too. Pulte to sign 7,500 single-family home for rent. This is on Pro Builder. Builder Pro Pulte agreed to construct 7,500 single-family detached, not attached, build for rent homes over the span of 5 years for single-family rental company Invitation Homes to purchase. Now, if you constructed those, you would enter the market 25% lower. We used to do roll-ups with, we constructed homes for investors. I still do. I'm building 6 right now in Ohio, and with my various partnerships. And one of the Pulte doesn't really get below 400,000. They bought Centex, and Centex really got away from it. Their teams, they bought a firm in the Midwest because they couldn't enter that. So Pulte would not be the firm that I would ever partner with on something like this. Ryan Homes is. The homes will be located across 7 of Pulte's communities, and initial projects are in Florida, Georgia, North Carolina, Texas, and South Carolina. Now, this is old news. That's 4 years ago. Markets changed. So would I do those states again? Most of them. But I would do Florida and Georgia, absolutely. I would not do California. I would do parts of Texas. We look at the I-10 corridor because of shipping routes, so from Houston to Jacksonville and the entire Gulf Coast that it wraps, that goes all the way out, and it's a distribution pathway all the way out to California. So we follow logistics first, but that's part of it. We want people to live close. If you look at D.R. Horton, all of their homes they build, the majority are in communities where there's no competition, and they're typically the first market entry. But when you look at communities like Bellefontaine, Ohio, where they entered and Clayton Homes / Arbor Homes entered, their homes sit while the lower price bands under 300 don't. D.R. Horton can't get below 330,000 in our market because they don't have a floor plan that allows for it. And we've recommended that they do because we broker land up where I'm from, and we try to sell it to them. So it says that Million Acres notes that the partnership is fully beneficial. Newly built homes mean lower operating costs for Invitation and highly attractive product for potential renters. That's 100% true. And if you read their financial statements, a lot of the focus, we've done financial modeling, and I've built everything from 600 square feet all the way up to maybe 2,800. We have probably 10 floor plans that I've designed, and we have every floor plan of every builder. But this is part of those. It says Pulte Group will benefit from the agreement's certainty, providing security against outside factors. So that's what we do. The building as a service is a massively expanding market. Building for for Wall Street, but no one's taking direct positions. People still want to purchase merchant builds. D.R. Horton in our market just built an attached individually parceled plan, which means we can trade one or two houses. That's one of the strategies that we're looking at as well. Chicago firm bought it, and the individuals that did it was in Reynoldsburg. Let me see if I can find it. It was Renner. I'll show you guys what it looks like. Renner Park, D.R. Horton. These are the styles that they bought. It was an attached 2-story, and these have done the best. 3 stories by Ryan Homes, they had a little bit of trouble. And a lot of the times, Ryan Homes, because of where they go, like Dayton, Ohio, they had a lot of problems with credit. They've entered markets that they can't sell homes to credit. So when you talk to their teams, we talk to the lease-up teams. We go and visit. We do everything that we need to before we enter a market. So Renner Park, this was in Hilliard, Ohio, and you could look at the economics. And this wasn't the one purchased, but each one of these could be bought and sold. So they did it over in Reynoldsburg in Licking County, which is one of the fastest growing ones that's out there. And that's become amazing. So anyways, we look at builder concentration for buyer demand, and it's one of the strategies that we want to employ as well. But our goal is to move a little bit quicker and start owning real estate, and that's a part of it. So insurance as selection filter. Florida's 12% insurance to rent ratio creates mom and pop exit pressures, but institutional operators with master policies and captive reinsurance maintain margins. Louisiana, coastal, Mississippi follow similar patterns. Distress becomes opportunity. They do, if you look at insurance ratings, we underwrite those as well. It's not all the coast. If you're further in, I'll show you guys Gadsden County, Florida. This is an example. If you were in southern Florida, Quincy's the one that we were talking to Quincy. So here's the state capital. We wanted to be close. We were looking at land deals along here. And we found one right here next to Quincy on the south side over here, which was really close to this. We had frontage all along here. You can see like this. So you can build out hotels. There's a Holiday Inn. And then we look at that and match it up across opportunity zones because that's huge. We want to partner with groups like Peachtree and other operators. So along here, we could sell at the out parcels. But that's an example of a market where it's not on the coast, and it's on I-10. It's on this I-10 corridor belt that comes all the way across and into places where we try to invest, or main distribution corridors like this, right? So trucking routes, you see this, 55, 59, where I'm from in Ohio. This is where we did deals, and then we expanded to Buckeye Lake, Newark, Zanesville. A lot of investors are going over here into Wheeling now because of the fracking boom. And because of Pittsburgh, there's a lot of energy reinvestment because of AI and access to water down here. We've seen a lot of those types of trends. And then you have Springfield here. And Dayton, Vinebrook Homes in Dayton had a massive problem. If you guys look about Vinebrook right here, Vinebrook debt. Look, here it is. Why is Vinebrook Homes in trouble? Vinebrook Homes is in trouble due to a combination of tenant complaints, significant financial pressure, widespread tenant grievances over issues like unresolved maintenance and aggressive rent collection, and threats of eviction. Now, if you're not paying your rent, that's fine. But I think the way that you do that can be better. Your residents are your people, so you have to be respectful to them. Concurrently, its rapid expansion led to a substantial $1.2 billion debt, forcing it to sell thousands of properties nationwide to manage the financial burden. That's true. We saw a $99 million purchase because we pulled property records in Dayton within the last year or two. It might have been 2 years ago. That had to happen. Additionally, the company has been involved in lawsuits with cities like Cincinnati. That's why we try to stay out of cities and unincorporated areas as well, because there's no one that we answer to except the county. Tenants, unresolved maintenance, aggressive city lawsuits, deteriorating properties, numerous buildings and safety. So Vinebrook bought in Dayton. Dayton has an old market and old housing stock that's older than the 1940s. And they took a very large position in those types of homes, which is very poor. Hazardous wirings, and that's this wiring type, it's just part of an inspection because they bought it. They bought a home with wiring like that. You can't buy homes that have wiring and can't be insured. So having an insurance underwriter or adjuster on our board, we would love that. That would be amazing to be able to give us the insurance perspective of buying from a large REIT's perspective. The debt is one of the big ones. To address it, it's selling off homes. You can read some of these other ones. It's ditching the Midwest it sells, which we don't have to. The Midwest is a great place to invest. Why are they ditching the Midwest, but American Homes for Rent isn't, right? Vinebrook Homes is a single-family rental company. Debt, selling off homes for maintenance. 27,000 homes in the Midwest. Tenant complaints, rent complaints. Those are the types that we're talking about, okay? The last one was foreclosure velocity and deal flow. States with foreclosure rates generate consistent acquisitions. This is the foreclosure rates. Unlike cyclical distress spikes, baseline foreclosure flow supports steady portfolio building. You can benchmark that against peer cities. We look at debt as a tool, right? And we want to use it sparingly. If we go to markets where people continue to default on their homes and they're getting 97%, large FHA, if they're flooding the markets with loans that shouldn't be, then that's going to create strong renter pools in 5 years when they can't, or if they can't afford. So either way, this is a little bit about our criterias. You can, on our website, book an allocator call. That's going to allow you to either fill out a contact us, tell us what you're interested in. Maybe you want to be on the board. Maybe you want to do something else. You can call or email me, connect with me on LinkedIn, or you can schedule a strategy call with myself on my calendar right here, just like that, if you're an accredited investor or family offices that wants to have a discussion. Over here, you can do the same thing. If you're accredited, you can grab our 2-pager right here, the request for investor materials. What you're going to get is the fund overview, a 2-page summary of investment criteria and track records. That's my 11-year track record. You're going to get a follow-up from myself or one of our investor relations teams to contact you regarding just having a discussion. Same thing. We're just going to move to a strategy call. But this allows you to hop on, and we're pretty transparent about some of it, but there's a little bit more information in there if you want. And then accreditation, that's what you're going to be able to do in there. We have press releases. This is ours. HLP Fund announces $50 million Gulf Coast Equity Fund focused on capital light housing across the Southeast. Miami, Florida, that's what we're based out of. October 17th, that's yesterday. HLP Fund, marketing name for Midwest Residential Growth Fund 1, announced the launch of the Gulf Coast Equity Fund, a $50 million vehicle targeting Tier 1 and Tier 2 metros across the Gulf Coast and Southeast. A strategy emphasized capital light housing, SFR clusters, manufactured and modular partnerships, and infrastructure JVs, sourced and underwritten against public REITs and homebuilder benchmarks. You guys just saw that. Why now? Following multi-year inbound migration to Texas, Florida, and Tennessee, and the Carolinas, relatively affordable versus coastal markets, and durable household formation trends, HLP's thesis concentrates on submarkets where institutional operators report high occupancy and stable rents per Section 10Ks and investor supplements. Approach: Wall Street discipline, Main Street execution. Buy box: 3 to 4 bedrooms, 2 baths, 16 to 2,400 low-turn neighborhoods in your employment basins, logistics corridors, everything else. You know, I have Americold on my phone number. I could call Americold right now. I can call Lansing, Michigan, or I think it's Detroit, 248, where Champion Homes is based out of. We looked at, they have a big factory in North Florida on I-10, where I-10 hits. They understand logistics, and so we're a logistics first. We're following logistics. So the structure is fee simple SFR clusters. Now you can see these as attached. DR Horton's done a great job with that. JVs with mobile home park operators, selective capital light builder partnerships, and risk policy, insurability, fund width screens, leverage caps, underwriting committees with comp checks. For allocators, the intelligence hub, that's benchmarks. That's where we just went. Sources data from SEC filings, FHFA, you have Census, BLS, Freddie Mac, Fannie Mac, REIT supplements, and regional MLS feeds. CSV exports and methodology are available site-wide. We're still building those integrations out. This is for me. The Gulf Coast offers institutional-grade fundamentals, migration, affordability, high occupancy at a fraction of the basis you see in primary metros. Our data-first approach gives allocators the transparency they expect from public markets with the alignment of private ownership. More than that, I don't make decisions, a committee does. That's how private funds, the best private debt funds always worked in the past. Our focus is not on debt, it's on ownership and equity creation, low leverage, the standard buy box that's been around since 2008. About HLP fund, that's short for horizontal land partners. HLP fund invests in essential housing across the Gulf Coast and Southeast, applying institutional underwriting to capital light structures. HLP fund, Gulf Coast Equity Fund, and HLP Gulf Coast Equity Fund are marketing names for Midwest Residential Growth Fund 1, LLC. Media and IR, Rob at hlpfund.com. Here's my number and that. You can book a call just like that. You can also request fund materials just like that. Super easy, guys. I built this site all on our own because we run a media company. It's very simple, very easy to use. Let me know if there's something you want changed on here. And I'll show you something. Let's see if we're discoverable yet. What is HLP fund? This is the types, right? So housing, land, and property, that's not us. So we'll be pushing out. We want to be discoverable. That's called agent engine optimization. But anyways, thank you so much for watching, guys. We want to show you a little bit. And I'm just going to show you really quick, Jackson, Mississippi. It's one of the top wholesaling markets this year, which means, we talk to the buyers and sellers here, and they say, please bring an offer, please buy it. This, the situation is homes for sale under 50,000. I'll show you what we're looking at. I looked at one yesterday. These are homes that are, you can see these are pending. They're buying them cash. Now, we don't buy, a lot of banks, they have to buy them and go through the whole process. This is the type of home that, this doesn't have a garage, right, which we try to look for, but it's got the right 3-bed, 2-bath. It's $34K, $21 a square foot, built in the 60s, which is exactly why we like this. I bought 500 and sold 500 houses and did a lot of other activity for investors. And these types of apartments, this is built after record-selling apartment complexes that I sold as a broker in the Midwest. So what we're looking for is as is, right? These types of homes don't need a lot, and then when you rent them out, they meet exactly what you're looking for. If you look at where this is at within Jackson, and we just zoom out at a greater base, it's in a subdivision, you see? This is exactly what Reynoldsburg is like, where American Homes for Rent entered 10 years ago, and you can see how it has access to. Jackson is a major corridor for 55 and for I-20. And you could see where these are at. Now, what would we do with something like that? We would work or try to work with a Section 8 placement tenant. Instead of, we would try to have high quality housing. We would work with the turn crews here. Jackson's our number one market. If we can raise $5 million, we will give exclusivity to someone in that market and I can't wait for that. So if you're an accredited investor and you want to be a part of what we're doing, this is the best part. If you look at this zip code, 39204 in Jackson, 39204 pricing, home history. You'll see faster appreciation than the state of Florida. Let's double check here. Oh, that one's going down. One of the other ones we looked at was 20. It talks about the median homes, the number of homes. Now, we could have bought all those homes in that market. What happens when you buy all the homes in a market is you push the prices up. They're down 11%. There was one more in Jackson that was up. Jackson, Mississippi. 20K house for sale, Jackson. Let me see if I can find one. Jackson, Mississippi, for you guys. Look, we got DR Horton building in Jackson. They have consumer confidence. You can see what mobile homes over there. So it's a really good market. You have everybody that's in Hinds County. Let's check out, I think ours was over here. I pulled one over in this neighborhood. Let's take a look at this one. That's only a 2-bed, but we look at, this is what our software pulls in. So this is the type. This means that pricing trends, I can't change the past, but I can buy on it with real estate trends. 39209. Let's see here. Here it is, realtor.com. Okay, so this shows the market. And with it, the same zip code, there's bigger homes up here, right? This is what we love to see is price disparity. The best zip code where I'm from, this is what it looks like. The median home price is 65. We can enter under that. The median days on market is 102. It's a softer market. It's not 4 days. And on the 1 year trend, they sell in 102 days. Let's see if we can find the pricing. It's like prices are up. Let's see what the rents are. 700, 1100. This is the exact kinds of homes that we would buy. This is a small portfolio where we would grab and scoop that up. But remember that single family homes, in my market, 92% of activity is single family homes. It's not apartments. So holding apartments, but as more people enter the apartment space and flood it like Grant Cardone and multifamilies, we think that single family home, detached or attached, that are fee simple is actually the methods. And that's what I think a lot of others are seeing. The prices are trending upwards 10% right now. So if you pull these pricing trends from a public database, like right here, home search, and I can pull in a zip code, I can pull in pricing trends on a scraper, which is what we do. And then we can use AI and machine learning and predictive analytics to predict where we might want to buy. You can see there's some flexibility, but if you came in and bought 10 houses in here, there's plenty. You have to look at the supply too. Everything's just driven by economics. So that's an example of the median days on market, how many people are buying them, what the rents are going for. And this is a different place, but if we pull both of those in, and we wouldn't want rents, we would want apartments. So I don't think that we take single family homes. This is the 16. If you look, single family homes rent for more. We would never buy a 2-bed. Look at the 3-bed here. What is the premium product? It's that 2,000 square foot that we talked about, where it's a 3-bed as well. Down here, it's a smaller one. They're getting less rent. And the number one thing that you want to do is get higher rents. And it's driven in Section 8 rentals. It's driven by bedroom counts. So larger homes with more bedrooms. This home would rent for the same as this one on Section 8. This one looks a little bit nicer. So this is an example of a post. This is what a post-turn home could look like. It has wood floors. You see it's been painted. I used to own a nationwide painting contracting. We just did a $400,000 paint job for an affordable housing developer in Florida. So I'm just really in the weeds when it comes to this stuff. These are not the types of houses we would buy. You can see the rents are really low, and these homes tend to have trouble selling. So sparingly we will buy. This is okay, though, all day long. All day long. These are the types of homes that worked where we were at. Some have basements, some don't, and we might split those into we can do sub LLCs within a larger one. We could say garages, no garages, and separate them out like that and see how it does and flip the no garages portfolio to Wall Street some other time because we're doing all the work. Thanks for watching, guys. My name is Rob Ellis. I am a principal here at HLP Fund, Gulf Coast Equity Fund at Gulf Coast Equity Fund, and Midwest Residential Growth Fund 1, Horizontal Land Partners, and based out of Miami. If you want to reach out, please, we'd love to. We're currently doing our $50 million raise for accredited investors only. This is not a solicitation to pull capital. Thank you very much.